Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler. We're talking money and investing along with Evan Barner. PaulWinkler.com is our website, and you can check out all kinds of stuff there. If you need a 15-minute phone call, jump on. And any one of the offices, we got them all over the place. 10 of them all over the place. Can't be one that's further, more than a stone's throw from you. Anyway.
You can't swing a dead cat around here without hitting one of our offices.
Something like that. That's terrible. Oh, man. Cat lovers, I apologize on behalf of Evan.
Fortunately, we don't have the text line that people can text us and say, hey, what are you beating up on cats?
Yeah, stop. My cats would be the first one to text.
Right.
Oh, anyway, Evan, go for it, man, before we get in too much trouble.
we were, talking about engaging with, parents during Mother's Day, having some of these conversations. Mm-hmm. But at the same thing, we have a lot of people looking at retirement, and we were talking about people concerned. But, okay, if you're getting ready to retire or you just retired, now what? And, especially if you've just retired, and even if you still got another year of work, the current events kind of give you pause of, hey, what can I do? What can I plan on? Because you're a little bit more heightened awareness of the deal. And one of the keys in this one article was focus on what you can control. You probably talk about that a lot in counseling.
It's true, yeah.
And back burner, what you can't control.
Yeah, recognize what you can and have the wisdom to know the difference, right? Yeah.
And so the first thing was assess your spending rate. People who've just retired or are about to do so are particularly vulnerable to what retirement researchers call sequence of returns risk, which means that a bad market shows up early in your retirement is the risk in terms of this sequence of return.
So you got to know the level of volatility or the potential volatility of the portfolio. You better know that, yeah.
This was an interesting stat in 2025 retirement spending research found that the people most likely to run out of money in retirement were the ones whose portfolios lost value in the first 5 years of their retirement.
Yeah.
And that really does drive home the importance of having a diversified portfolio and kind of speaks to when you were comparing your stupid portfolio to a 90% S&P, 10% T-bills or tips.
Which is so the concentration we typically see in investor portfolios. Even if you're not doing an S&P 500 fund, we see such a big concentration in that asset category. And as people feel hunky-dory, everything's great. Oh, it's wonderful. I've been doing really, really well. I'm not worried about it. And, it's kind of like you're going along and all of a sudden the earthquake hits or the storm comes. And you were doing great before it hit, but, it's too late once it happens to do anything about it. You can't go back and say, hey, can I have a redo? Can I have a mulligan on this one? You've got to know what is likely to happen or what could happen beforehand. So, yeah, it's really important to understand that.
And don't just look at your spending, but if you're looking at it and it's not great news, then adjust your spending, And they said oftentimes it's just a small tweak here or there makes a huge difference. It's not like you just have to cut 30% across the board or something like that. You just have to pay attention to it. And certainly if you haven't retired yet, do a really in-depth look at what do you think your spending in retirement is going to be. And oftentimes, I don't know if you experienced this, Paul. I'd be curious. Oftentimes, we find that clients think they need more in retirement, but they don't factor in, I've got Social Security coming out of my pay. I've got 15% going into my 401k. All of a sudden,
and my mortgage might be getting paid off.
You may be making $100,000 thinking, oh gosh, I'm going to need it, but you only get 70.
Yeah. So and I think that's interesting because you made the point earlier that people end up spending more in retirement than they thought they were going to.
Well,
we look at it and go, well, Evan is saying, well, in our side, we find that people end up spending less than they thought they were going to need in retirement. What's the difference? Why the disconnect between them? And I think so often what happens is the type of people that typically come to somebody like us and they want to be engaged and understand their investing.
Yeah.
They really want to be engaged in the process. That tends to be a different type of person than the quote unquote average person out there. That's my theory. I think it's just the type of people that we typically tend to deal with. They're more engaged. They want to understand. They don't want to know what they're doing, why they're doing it. They want to be really, really prepared.
Yeah.
But a lot of people do not prepare as what I call for the greatest vacation or the longest vacation they'll ever take. I was talking to a lady at Channel 5 yesterday, and we were talking. She goes, "I just love that commercial, that you guys have, where you're talking about, you spend so much time. You're going on a vacation. You spend so much time preparing for it. Are you prepared for the greatest and longest vacation you'll ever take?" Most people don't spend a lot of time. And I just grew up watching a dad who did that.
Yeah.
That's what he did. Saturday mornings, he was sitting there. And here's a guy that had pensions all over the place.
Right.
He didn't really need to prepare as much. He was a military guy, So the reality of it was he prepared even though he didn't have to. But, that's watching a military guy. You have a different perspective on things.
Yes.
Yes.
We are a different breed.
Yes, you are. Which is good.
Here was a strategy that we talk to clients about all the time as well. I agreed with most of the stuff in this article.
Okay.
Pull cash flows
that's rare.
from safer assets.
Wait a second. What was that again? I was so shocked that you said you agreed with it. What?
Pull cash flows from safer assets. And so, again, you have to be diversified to have some safer assets to pull from so that when the market is down, that's what the fixed income side of your portfolio is for. That's where you take the spending.
Right.
Don't just deplete those asset categories pro rata. You don't take money out of each piece. Take money out of the pieces that are doing well.
And the other thing is that you got to really, really be careful that those types of asset categories, those bonds, those fixed income investments are safe. We see a lot of people come in and say, "I got this target date fund," or "I get this fund over," and you think, well, everybody's doing this. This is what people have. And we'll look at that and go, whoa, do you recognize the duration on these bonds? Do you know what the credit rating on these bonds are? And they're like, clueless. They have no idea. And duration, when you have a long duration, let's say if you have some kind of a bond fund with a duration of 20, what that means is, by definition, if interest rates go up 1%, they're going to go down 20%. And, you have a situation where all of a sudden interest rates go up, you can have stocks go down and bonds go down simultaneously, and you're sunk. Or if you have low quality bonds, high yield bonds. Yes, the marketing sounds great. They're high yield, high interest rates, and you think, wow, that's where I'm going to get my income in retirement. But when the economy gets soft, it's those companies that have to pay a lot to use your money, those high yield issuers, that end up going down in value because their interest rates go up even further, and bond prices go down when the risk goes up. And you can have a situation where the whole doggone thing sinks on you as a result of that. So recognize that not all bonds, not all fixed income is created equal. Really, really important.
Yeah. Circling back in this, they talked about playing the long game with Social Security. And we touched on that some, but I want to read a couple of these paragraphs because they do touch on the areas that you really have to be cognizant of to help make that decision. Early in retirement, many people feel the pull to replace the income they had while they were working. Social Security beckons in that it's a secure, inflation-protected source of income, much like a payment. But the lifetime benefits of delaying Social Security are hard to ignore. A higher income stream that also happens to be fully inflation-protected and will last as long as you do. Exactly what you said last segment. In our retirement income research, we took a look at the pros and cons of delayed Social Security filing.
Okay.
Excuse me. We found that delaying filing up until age 70 did enlarge lifetime income. This was the curious line in this.
Okay.
But the benefits are greatest if you have some other source of funds to draw from until your benefits start. So if you don't have any other assets, you still may want to take your benefits early.
No,
but,
you may not be able to work.
If you've got to keep the lights on, turn that faucet on.
Right.
And the benefits are also obviously more valuable for people with above average life expectancies in that they stand to receive those higher streams of inflation protected income.
Oh, for sure.
For a longer period of time.
Yeah.
And a lot of clients, when they ask me, like, hey, when should I take it? We always talk about life expectancy, but that doesn't come up in most of the articles you see or any of these rule of thumb things, you hear on ads of if everyone in your family doesn't make it past 74, you might want to take your benefit at 62.
And sometimes it's going to hard to figure out what life expectancy is. You can't just go look at a table just simply because that table is just everybody. Look at your family history. Look at what's your health. What do you exercise? Do you eat well, or do you you're a human trash can when it comes to eating? It can be different between different people. And do you have a pretty bad family history of health? Right. And so I'll typically have people say, hey, what do you think? And a lot of times people are fairly reasonable on their expectations on what their life expectancies are. Right. Yeah. But you definitely want to make sure that you spend some time on that.
And so that was it. Just, cool. Kind of control what you can control and don't sweat the stuff you can't control.
That sounds like wisdom to me.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax.
All right, back here on the Investor Coaching Show, Paul Winkler, along with Evan Barnard. It's Mother's Day.
Yes.
Got yourself hooked up, Evan?
Absolutely.
Y'all ready?
Absolutely. I got my wife a new chain link fence.
You got her a new chain link? Really?
Yes. That's what she wanted.
Is that okay? All right.
Not the most romantic thing, but I'm listening.
Well, okay. Yes. Yeah, that works. Okay. So we were getting into conversations up at the Goodlettsville office, got to talking about, things that we ought to be doing from a workshop standpoint.
Yeah.
Are we doing a tax? You and I are doing anything else tax-wise?
It's not on the schedule.
Not on the schedule. Are we doing anything else in that particular area? And then we talked about that. We talked about Social Security.
Yep.
And there is a Social Security workshop out there on the website, and we update that on a pretty regular basis over at paulwinkler.com. The Medicare workshop that we have there. We've got that video that we had done, which was Why Aren't We Tripping with Over Wall Street Millionaires?
Mm-hmm.
That, I think that came out really. We're doing another version of that, though. That's going to be coming up. But that is I think it's a really good video just to check out, just to go, okay, what's going on, with regards to why aren't we getting better results?
Right.
Why is it that investors get such bad results when it comes down to, how they're applying the investing process? And, the whole thing that I find so often is you have something 80-90% of money flowing into target date funds. I go to work, I am told, hey, log in, set yourself up, or they may be automatically put into a fund for their retirement date, 2040, 2050, 2060, whatever that is. And they have no idea how that stuff is invested. They don't even know what's going on inside of those portfolios. And I find that too often people end up in a situation where, they might be down the road with a fraction of what they thought they were going to have, or when U.S. markets inevitably take a dive. I mean, they'll do that. It's just the way markets work. And, is it going to be something like where we had technology stocks that dropped 80% that causes it? What's going to be the catalyst? You don't know, and you don't know when.
Right.
But once it happens, it's too late. And you got to just recognize that the investing industry, as we talked about earlier in the show, we talked about the big investment firms that are handling so much money. That one firm that we were talking about, billions and billions of dollars, and especially younger investors that are getting pulled into that. And they're going, hey, we'll just offer everything to everybody. We'll just give you whatever you want to have access to. We are just a smorgasbord, and, we're a vending machine, and we're not going to necessarily worry about whether that stuff is good for you or not. We're just going to give you access to everything. And some people, it's a lack of discipline. Maybe it's they get into. There was this one study I was looking at, Evan, this week, and the study was interesting because I made a comment in something I had done this week, and it was about how there are psychologists that say upwards of 100% of our decisions are emotional in nature. So if we look at how we make decisions as humans,
right?
And it was making that comment, and I said to my son, I said, "Hey, bud, we got to make sure that we actually reference where that data comes from, because that's a pretty extreme number right there.
Yeah.
Anytime you say 100% of your information or the decisions that you make as an investor are emotional, you got to be able to have some kind of way of justifying where that information comes from. And it was actually a study that was done. And this one guy was fascinating. Antonio Damasio was his name. And his point was that he argued that emotion is essential for all decision making, not separate from it. So I got in a conversation with a guy who he fancies himself as Spock. Remember years and years ago, Evan, we had this whole thing where we had conscious investing for peace of mind.
Yeah.
And then we had this whole thing, the investor's dilemma that we would do. People have a fear of the future. They want to predict the future. Well, they want to look at the past because we think, somebody who predicted the past and predicted things in the past will be good at predicting things in the future, right? So we're talking about that. And he just fancies himself, he's Spock. And it was kind of funny. It's like, well, I'm not emotional at all. I just make every decision on strict logic.
Is he still single?
and I'm just laughing, going, "You think you are?" And I says, "I wonder if that's coming from pride." and of course, pride, being emotionally driven. And then if you question it, the person would get angry, which is an emotion, right? And we think that we are so logical.
Right.
And the reality of it is, so often we make decisions about everything, and it comes from an emotional bent, and we don't recognize it. We don't realize that, as one guy that was a neurologist, I guess a neuroscientist is what he put it this way. This neuroscientist said, your brain is a mansion.
Yeah.
But the conscious part of it is a broom closet.
Yeah.
You have no idea what's really driving your behavior. Status quo bias, like I talked about earlier, is just the bias that says, just don't do anything. Well, where does that come from? Well, it certainly can come from, if I make a decision, I do something different, I change course, I could be making a mistake, and I'm afraid of making a mistake. And that's why we always tell people, go through an education process. We tell people, don't come in our office and say, here, I want you to manage our money. I tell people, do not do that. And guess what? We're not going to do it anyway. We want you to get, what am I doing? Why am I doing? You don't have to know everything, so don't let this scare you. Because some people can have this lack of confidence and think, oh my gosh, you're going to be over my head and I'm not going to get it. But we want you to get what you're doing, why you're doing it, expectations, know what can happen, how it works, where this data comes from, so on and so forth. Because when you get this stuff, your level of confidence goes way the heck up. That's our experience of this. But and then The other thing that we do is we typically look at hindsight. We look at, what happened. Oh man, if I knew that was going to happen. Well, if you knew that was going to happen, you would have bet your entire fortune on that happening.
Yeah.
Or we look at false patterning. We look at things that have happened in the past and we think, well, that happened in the past. That's what's going to happen in the future. And we don't recognize that all of this stuff is emotional. It's all emotional. I have a chart in my office anyway. And it's a list of hundreds of psychological biases that drive our behavior. And we don't recognize that that's so often how we make decisions. So what we look at is how can we build the C? How can we build the cognitive part of your brain just so that you're doing things and you just kind of know why you're doing them. And you get that there's some science behind it. And people don't recognize that there's a lot of evidence-based research on how markets work. And it's so logical. You don't have to throw your brain away. I mean, that's always the way I've been. I tell people that I swear my mother passed through Missouri when she was pregnant because you got to show me. It's got to make sense. And so often people invest blindly, and that's our big thing is don't do that.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.